Hi friends, welcome to GRADE B. We are back with yet another very important lecture from the history of finance and economics. Right, this is a topic that everyone should know whosoever is studying in finance and economics. Right, global financial crisis of 2000. So see, it started somewhere around 1995 late. Okay, or you can say 1996 beginning. Okay, 1996 beginning. This has started, and in the background goes there. Okay, so let's begin the topic. If you see, this is a graph, right? So this graph is of US stock market. So in this slide, let us discuss and understand what is the background of the crisis, right? So you see that uh, this is a chart from 1996 to 2005. Okay, you see that during the year 2000, okay, during the year 2000, we see a sharp rise in the stock prices, and then there is a steady decline. Okay, there is a decline in the stock prices after 2001, right? So this is the background, right? So many topic in many book you see that the start is being said as 2001 where it has started, but if you go, the background goes somewhere around 1996. So that is not important. What is important, what actually happened after this? This is the background. This is called dot-com crisis or dot-com bubble, where the stock market rallied for all the technology company, and then there were sharp decline. Right? Let's not discuss what actually happened in dot-com crisis. We are studying global financial crisis. Okay, so let's begin. This is the background, right? So see, there is a sharp increase and then there is a decline. And when there is a sharp increase, you see everybody would rush towards the stock market. Currently what is happening in India, every day, almost 4 days a week, you will get a news that the Sensex or Nifty has climbed by X number of points, right? So every day there is a positive news. So by hearing this positive news, even you and me, people like we also jump into the stock market and start experimenting. This is what happens in the period of boom. But what happens one day this started to decline, the losses begins, right? So what happened during this time? The interest rate in the US. So you see the stock market crashed when from the year 2000. You see there is a steady decline, right? So this shows the crash. Stock market crashed. So when you see the stock market is crashed, will you invest? Will any investor invest? The answer is no. Nobody would be interested in putting out their money in the burning market, which is crashing, right? So this is the background of the global financial crisis. Now we will begin with the topic global financial crisis. Let's understand. See, faced with the bursting of the dot-com bubble, a series of corporate accounting scandals. So let's not understand what dot-com bubble was. Okay, that is altogether a separate topic and separate. It requires a separate lecture for further discussion. So let me know in the comment section that if you want that, we can obviously do that. And September 11 terrorist attack. Okay, the Federal Reserve lowered the federal rate from 6.5% in May to 1% in June 2003. So see, 1% is the interest rate. Now, will you be interested in increasing in investing in banks? The interest rate in the economy is low. Why? You see, the stock market is crashed. So this shows that there is a low profitability for corporate. Number one. Number two, slower economy. Slower economy. देखो, any country in the world, okay, it's the private sector and also the public sector. Okay, specifically private sector is ruling the stock market, right? Even if you see in India, If the stock market goes up, this just shows that the sentiment of the corporate is good. The profitability that they're earning is good. There are other factors as well, but in general, this is what happens. So when the stock market is low, right? When there is a terrorist attack, now the only option that left for the Federal Reserve was to lower the interest rate. Why? Because they want to give the boom to the economy, right? They want to give the boom to the economy. So they have reduced the interest rate from 6.5 to 1%, right? So then what happened? Then you see people were confused between investing in stock or keeping the money in bank, right? Keeping the money in bank. So for an investor, okay, this is an he or she said no to both because stock market crashing, and why not a bank? Because of low interest rate, right? So where will the investor go? So the investment option in front of him was home, okay, plots, rent, stocks, gold. So you have already seen stocks, no option. And in US, people usually do not invest in physical gold. They invest in digital gold, right? And digital gold is also, I mean, the paper gold with the central bank, like they have in sovereign gold bond, right? But since the stock market was crashed that time, the sentiment for this was also low. Then people started to explore the real estate sector, right? Then and also what happened that time, US government encouraged to purchase house. मतलब जलते हुए घी में आग डाल दिया किसने? यूएस गवर्नमेंट ने. यूएस गवर्नमेंट सी for any given government, right? When there is an exchange of money in the economy grows. चाहे वो यूएस हो, इंडिया हो, कोई भी हो, right? So US government encouraged to purchase the home. Okay. Then since interest rate in the economy was low, people were buying in EMI. भी आपको पता है EMI is low, right? Then so demand increased and hence the price. So when more and more people jumped and started to buy the home, the house prices increased, right? So big investment jumped into the real sector. So this is what happened. Initially started with the small investors, right? Then when the price was booming for the real estate sector or the housing, then the big investors also jumped into the real estate sector, but not in this way. So they have come to a different route that we will explore now. See, these are the set of investors, right? They are willing to give money. I mean, they are willing to invest, but not in terms of buying the home. Okay, so there is a background story. Let us explore that story, right? So let's begin. See, let's now consider they are normal people like you and me. Okay, so they want to invest. They have gone to the bank for loan and they have got an easy loan with low interest and they have bought the home, right? They have bought the home. Now understand, now bank will, so this happened with almost, you can say, most of the people in America during that time, jumped towards bank to get the easy loan and purchase a house. Okay. So when there is a huge demand for the house, the prices of house means whatever. See, let's say a house cost 35 lakh. Okay, was costing 50 lakh because of heavy demand. Because of heavy demand that time. And banks were easily financing them because they know that this is an asset-backed security. So bank were giving loan to these people. But you see, bank will also have limited amount of money left with them. So they have turned towards investment bank. investment banks. Now you see, investment bank will not give money to the bank by just seeing their face, will they? No. So what happened? This bank sold loans to investment banks, and in return they gave money, right? And again, what this bank did, bank took this money and again given loan, given loan to people like individual people, right? Understood? Now see what happened. So this loan, okay, so this loan is known as collateralized debt obligation. Understood? The arrangement between the bank and investment bank, the security was known as collateralized debt obligation. Understood? So let's move forward now. Now there is another agency in the picture. Now you see what will this, what will this investment bank do with this security? They will also need money. So what they did, okay, they have made the security paper, right? And they have gone to the rating agency who have rated it. And now since these securities are asset backed security, they have rated AAA, AAA, and this is known as the safest investment. Okay, and then this paper was, I mean, the money that investment bankers, I told you that many people jumped into the real estate sector. Now you see the real investors who were investing in the stock market had jumped and bought this security, which was rated AAA by Standard and Poor's, Moody, okay, of that time. Understood? So they have bought this security, and in return, investment bankers were getting the money. They were giving to banks. Banks were giving to loan, and this cycle continued. This cycle continued. Okay, I hope you have understood. And this cycle continued for a very long time. From it started somewhere around 2001. It has gone to 2008. Okay. So what happened after this? Now you see, when the cycle continues, okay, when this cycle continues, so initially what happened? The people who could take loan, like who have good credit history, who can repay, okay, they were taking the loans. And banks were really verifying those people and only giving the loans. But if you see this slide, okay, this cycle, everyone was earning, right? This rating agencies, they were earning by rating the CDOs, right? And again, on the other hand, investment bankers want to earn profit, so they were really pushing hard to the banks for security, right? And on the other hand, bank had the pressure from the investment banks, right? So they were giving loans to the people who were not credit worthy. So what happened at that time? Banks stopped verifying, right? So they were not that strict in verifying the documents, verifying that if the person can repay the loan or not. Bank were not verifying. So they gave some loans, and those loans are called subprime loans. Okay. Since investment bank demanded more loans from bank, why? Because they want to earn the commission. Okay. And again, investment bank had the pressure from whom? Although investment bank did not had the pressure from anyone, still you can say that the credit rating agency, right? So they failed to rate those security correctly, right? So somewhere or the other, you will find the discussion that the credit rating agency had the pressure on the investment bank to bring more security, right? And this investment bank, on the other hand, demanded from banks. Okay, and then the real crisis started, where bank failed to verify or were so lenient in verifying the documents, and they started giving the subprime loans people who could not repay it back. Okay, so bank gave loans without verifying proper documents, hence subprime loan. So this is known as subprime loan. And many a times you will find that global financial crisis of 2008 is also known as subprime crisis, right? This is the reason. Now, let's move forward. So, now what happened? Okay, so now you see there were some smart investors, right, who knew that one day this will fail, right? So, a insurance company, AIG was the biggest insurance provider of the US then, right? So, insurance company started to provide insurance of that what it was CDO. Okay, right? It's CDO. So you see, now there is another agency into the picture. Insurance companies started to provide the insurance. So even they were earning the commission by providing insurance this to CDOs. Now there were some very smart investors, right? And you can say that even Mr. Warren Buffett was also involved. So that this is smartness. So there were few investors who knew that this is a bubble, right? This is a bubble, and one day this is going to burst. But since they were earning profit, they were silent. So what they did was they purchased loan against their CDOs, right? So even if that fails, the insurance company will pay them. So they don't have any problem. So they were completely, backed by all the uh, all the financial loopholes. Like they have taken the, else you see who takes insurance for a bond. Let's say you have bought a bond, will you take insurance against it? Absolutely not. But then it happened. There is another agency in the picture, that is insurance agency. Okay, and now what happened? Now again this cycle continued. The insurance agency continued to provide insurance to CDOs. The CDOs were rated AAA by the rating agency, and banks put pressure, investment bank put pressure in the banks, pressure to the banks so that they invest more and bring more security for them so that they could earn the commission, and this continued for a long time, right? Now what happened after few years? Okay, from you can say from 2006 it has started, right? People started to feel the heat. So this is called adjustable rate. What happens in the US, initially the home loans are charged for 1%, and later in the year down the line, from fourth, fifth, sixth year, the interest rate will be high. Let's say 5% or 6% was the interest rate. In India, it's still somewhere around 10, 11%. If you want to take, no, sorry, for home loan, somewhere around 6 to 9% you will find home loans in India. In US at that time, initially it was 1%, then it moved to 5 to 6%, right? So, and people did not knew that the interest is going to increase in the coming future. Now, by the end of 2000, no, by the end of 2006 and by the middle of 2007, the interest rate in the economy was somewhere around 5%, from 1% to 5%. Now, what happened? The investors are not investing here. The investors are investing in stock market, right? And when the interest rate increased, the people who took the loan, who were not aware about the adjustable rates, stopped paying the EMI. Stopped paying the EMI. Now what happened? So when the loanee stopped paying the EMI of an asset-backed security like house, the bank had no other option except to sell those property, right? So bank started to sell those property. sell or auction. Sell or auction those property in the year 2007. Now, what happened? There were more of auction. Auctions were increased, but there was no buyers because all the genuine buyers of the home already have home now. Now, what happened to the extra home? There were no buyers, and hence the price of house came down heavily. So let's say bank have invested 50 lakh, okay, and now the property cost 35 lakh. So this is a big loss for bank, and the genuine people who took the loan stopped paying the EMI. Why? Because they have purchased. What happened during that time? Almost all the buyers, they did not spend a single penny from their pocket to buy the home. Almost 100% was financed by the banks, right? So when they saw that my property cost 35 lakh, why will I pay 50 lakh to bank? They have stopped paying the EMI, right? So bank were in huge trouble now. Bank were in huge. You understand? Have you understood where is this connection? If not, just revise the video. You will get to know, right? Let's move further. So yeah. So during this time, I mean during this bank were in trouble. Now bank do not had any other option, and now bank bought this money from where? From investment banks. So who are in real trouble? Trouble. The investment banks. Let's see the numbers now. See housing prices. So this is an image from the economic website, the balance, right? So you see houses price fell to 31.8%, right? So the house that costed somewhere around 100 rupees, if 30% falls, it will become somewhere around uh, 70 70 rupees. So why will you pay 30 rupees extra to bank? That is what people thought then. Okay. Now see 30 billion federal guarantee. Now somebody has to bail out. So US government and the Federal Reserve had bailed out. Still the crisis was not, I mean the crisis was so big that even with such big numbers also they could not, you know, they could not come out of the crisis. The crisis, the bubble had burst and had a deep impact in the global economy. So, for deals between BSMs and JP Morgan Chase, right? So, these are the investment bankers. 182 billion federal bailout for AIG. Now, who was AIG? The insurance provider, right? So, the smart investor, they earned, right? So, this 182 billion, you can say this has gone to the entirely pocket of investors, smart investors, right? And they were big in overnight. Unemployment was still above 9% in 2010 in the US, right? 144.5 billion moved from money market to treasury bonds. Okay, 144.5 billion. So treasury bonds, those CDOs, right? Then US Treasury later sold the shares for 22.7 billion in profit. So later the US Treasury sold because AIG, the money was given in exchange of shares of the company, right? Fannie Mae and Freddie Mae guarantee 90% of all mortgages. Okay, so now you see this is the cost. So let us see the cost in a graph. So see tax cut 831 billion. Okay, the investment bank Beers Stint bailout was $30 billion. Okay, Fannie and Freddie bailout 187 billion. Look at the quantum. TRP bailout, it's 440 billion. You see the amount. The total amount is 1488 billion. This is the cost of the crisis that US government and the US Federal Reserve had to go through, right? So this is too much. Now, who is to blame? Let us see that. The lenders who marketed home ownership to people who could not possibly pay back the mortgages they were offered. right? Lenders means simply the bank who could not offer loan to the proper people. They did not verify the loan, the paying capacity of the people are to invest. The investment gurus who bought those bad mortgages and rolled them into bundles for resale to investors. Okay, who bought those bad mortgages and rolled them into bundles for resale to investors means the investment banks. The agency who had those mortgages bundled top investment rating, making them to appear to be safe. The rating agency, right? Rating agency. The investors who failed to check the rating or simply took care to unload the bundles to other investors before they blew up. Actually, the investors, because, and yes, you see, the investors are also to blame because there were few smart investors who knew from the beginning that this is a bubble. So then, which bank failed in 2008? Very important. More than 500 banks failed between 2008 and 2015. See the crisis. Compared to a total of 25 in the preceding 7 years, according to Federal Reserve of Cleveland. 16 most were small regional banks and all were acquired by other bank along with the depositors account. This is very important. The biggest failures were not bank in traditional Main Street sense because the money were not of banks. The money were actually put from the investors, and the smart investors had already, gained through the insurance. So the real people who were lost at investment bank, like Lehman Brother. Okay, Lehman Brothers was denied a government bailout and shut its doors. JP Morgan Chase bought the ruins of Bears Stearns on the cheap. So very two big companies or the investment banks was failed. As for the biggest of the big banks, including JP Morgan Chase, Goldman Sachs, and Bank of America and Morgan Stanley, all were famously too big to fail. They took the bailout money, repaid it to government, and emerged bigger than ever after the recession. Right? So yes, they did something wrong. Still, they were, backed by the government also, and they are also known as too big to fail banks. Okay. So with this, we have come to the end of this lecture. We wish you very good luck for your preparation. Thank you from Team Grade B. Before I say goodbye, I would like to remind you to visit the website and look up on our course for NABARD Grade A and Grade B. Right. So this is one of the most economical and best course available in the country. Why I say the best course? Uh, we would not say, rather we would ask you to go ahead and check by yourself by downloading the app from Google Play Store and going to our YouTube channel. You can find some uh, reviews of the students who are working on the respective organization and they have given the review of our course in a video. So you can watch them and make a fair decision. With this, thank you and happy learning. Let's meet in the other lecture.